If you're running a business in Canada, especially in construction, transport, or manufacturing, you know that growth really comes down to one thing: having the right gear. But that gear, well, it's expensive. So in this explainer, we're going to pull back the curtain on how equipment financing really works in Canada. We'll show you how it can be the absolute key to scaling up your operations without having to drain your bank account. Okay, so let's make this real for a second. Picture this. Your company just landed a massive contract. Fantastic news, right? But you need a new bulldozer to get the job done. I mean, who has 200 grand in cash just sitting around? Most small businesses and startups definitely don't. And that's the exact problem that equipment financing was built to solve. It's the bridge that gets you from where you are to where you want to be. So, how do you get that bulldozer? Well, this brings you to your first major fork in the road. You've got to choose the right financing path for your business. Let's break down the two main options you've got. At its heart, equipment financing is what we call a secured arrangement. You know, the best way to think about it is like a mortgage, but for your business. Just like a bank uses your house to secure a home loan, an equipment lender uses the gear itself, that bulldozer, a new truck, whatever it is, as the collateral. So if things go south and you can't pay, they take the equipment back. It's that simple, and it's what makes lenders feel safe enough to make these deals happen. This leads you to that first big choice. Are you going to get a loan or are you going to lease? It really boils down to one super simple question. Do you want to own this thing right now, or do you want the option to own it later? With a loan, it's yours from day one. With a lease, you're basically renting it for a while, and then you get to decide if you want to buy it when the term is up. Let's put these side by side. If you're worried about cash flow, leasing is fantastic because the upfront costs are usually really low. A loan, on the other hand, you're probably looking at a down payment. When it comes to ownership, a loan gives it to you right away, while a lease kind of keeps your options open. Now, tax benefits? Oh, this is a huge one. We're going to talk more about it in a second. And finally, you've got flexibility. Leasing makes it way easier to upgrade to the latest tech, while a loan means you're pretty much committed to that piece of equipment for the long haul. Okay, so you really want to pay attention to this tax point because it's a big deal. The Canada Revenue Agency, the CRA, they look at these two options completely differently. Your lease payments are seen as an operating expense. That means the entire monthly payment can typically be written off, 100% tax deductible. With a loan, you can only deduct the interest you pay and the equipment's depreciation. That difference can have a massive impact on your company's bottom line at the end of the year. All right, so you've weighed your options, you're leaning one way or the other. Now for the part that makes most business owners a bit nervous: actually getting approved. Let's pull back the curtain and see what lenders are really looking for. Turns out it's not some big mystery. Lenders are basically looking at 5 key things. Number 1, your credit score. And yeah, they'll look at both your personal and your business history. 2, how long you've been in business. That 1-year mark is often a really important milestone for them. 3, cash flow. You've got to prove you can actually afford the monthly payments. 4 is the collateral, which, as we know, is the equipment itself. And number 5, and this one is pure gold: work on hand. If you can show them you have signed contracts ready to go, you're proving that new machine will start making money right away. And this right here is the key mindset shift. You have to understand this. You're not just asking for money based on what you've done in the past. You're actually presenting them with a forward-looking business plan. You're proving to the lender how this new asset is going to generate revenue, which makes it a safe and even profitable investment for them to back. Now, if this whole approval thing still feels a bit intimidating, just look at this number. One major Canadian financing company reports a 91% approval rate. Let that sink in for a second. The big takeaway here is that this is so much more accessible than most business owners think. The whole industry is literally designed to say yes when you bring them a solid business case. And what if your credit isn't exactly perfect? Is it game over? Not at all. It's not a deal breaker. In Canada, we have a huge market of what are called alternative lenders, and they specialize in these kinds of situations. Now, there might be a trade-off, like a bigger down payment or a higher interest rate, but there is almost always a path forward. So where do you actually go to get this financing? You're ready to make a move, but who do you call? Let's map out the 3 main types of lenders you're going to find here in Canada. The market is pretty much split into 3 main categories. You've got your big traditional banks, then you have this large and growing group of alternative lenders, and finally, you have specialized equipment financing brokers. Each one of them plays a slightly different role in the ecosystem. Knowing where to start is everything The big banks, they'll usually offer you the absolute best rates, but they also have the toughest requirements to get in the door. Alternative lenders, they're much more flexible and often way faster to get you an approval, which is why they're a go-to for so many small businesses. And finally, you have brokers. Think of them as your personal matchmaker. They take your application and shop it around to their whole network to find the best possible deal for your specific situation. No matter which path you decide to take, please always follow this one simple rule. Get multiple quotes. Rates and terms can be wildly different from one lender to the next. Getting at least 2 or 3 quotes just ensures you're not leaving money on the table. It's that simple. Okay, we've covered the what, the how, and the where. Now let's wrap this all up with a really clear, actionable plan to get you started on the right foot. Here you go, your first 3 moves. Number 1, get pre-approved. Seriously, this is a total game changer. It means you can walk into a dealership or an auction knowing exactly what your budget is, and you can negotiate like a cash buyer. Number 2, get your documents in order. Have your recent bank statements and financials ready to go. It will make the whole process so much faster. And 3, start with your own bank. Give them the first shot. If they say no, that's fine. Then you can confidently move on to those alternative lenders and brokers we talked about. And that really brings us to the end. We've basically laid out the entire map for you. So the only question left to answer is this one. What's that single piece of equipment that will unlock the next stage of growth for your business?